Hey, Central Virginia. Housing affordability is at a 30-year low, mortgage rates are still above 7%, and our local housing market is still on fire. We'll cover that today in our May 2024 Housing Market Update. What is going on, party people? In this market update video today, we're going to be talking about three things. We're going to be talking about housing affordability, we're going to be talking about mortgage rates, and we're going to be talking about our local housing market and its stats. Let's jump right into it. So as you'll see in the graphic, housing affordability is at a 30-year low, which is leaving many millennials and also Gen Zers now to wonder if they're ever going to be able to get into home ownership. The median monthly mortgage payment has almost doubled in the last 5 years, jumping from a little over $1,000 in 2019 to just over $2,000 in 2024. In response to affordability and consumer demand, new home builders are actually starting to build smaller homes than they have previously. According to a recent National Home Builders Association study, 38% of builders built smaller homes in 2023, and about 25% of those builders said they plan to build even smaller homes in 2024. This is certainly great news, as entry-level homes has been in a segment of the housing market that's been ignored by new construction builders over the last couple of years, especially during COVID. But as real estate agents, we are certainly relieved to know that more inventory is coming to that entry-level home segment of the market. And along with rising home prices, mortgage rates are definitely a large factor in the affordability crisis that we're currently experiencing in our housing market. As of this recording, May 13th, 2024, according to the Federal Reserve of St. Louis's numbers, the 30-year fixed mortgage rate is sitting right at 7.09%. Now, side note, I always like to add that the 40-year average for mortgage rates is 7.7%, so we're still under the 40-year average, but 7% interest rates are definitely a factor in our affordability that we're experiencing in the housing market right now. Now, rates have maintained around 7% in large part because the Fed has decided to maintain the target federal funding rate between 5.25% and 5.5%. And why have they done that, you might ask? The first reason is inflation has been stubborn, and while it's coming down, it still remains over the Federal Reserve's target inflation rate of 2%. And the Federal Reserve is reluctant to ease restraints before that inflation rate gets to the 2%. Chairman Powell was recently quoted saying, reducing policy restraint too soon or too much could result in a reversal of progress we have seen in inflation and ultimately require policy to get inflation back to 2%. So essentially, they don't want to loosen up their grip on that federal funding rate until we see inflation come down a little bit more, which has been stubborn to do so. And with this news, experts are still predicting mortgage rates to come down, but that will take longer and will not be as drastic as originally projected / hoped for. So with this grim news about affordability and mortgage rates, one would assume that our local housing market must be in shambles. And if you are one of those people that are assuming that, I am relieved to tell you that you would be wrong. So in the month of April, the median home price was $415,000, which is up 9.2% year over year from April of 2023. Our median days on market was 7 days. So that's the time from when a listing hits the market to when it actually goes under contract. Once again, it was 7 days in the month of April. The median percent of listing price versus asking price was 100.4%, meaning that on median, sellers are getting 0.4% over their asking price when they go to sell their homes. And last but not least, for my data nerds out there, our month supply of inventory was 1 month in the month of April. And therefore, based on that metric, we are still in an extreme seller's market. Now, I will admit we are seeing less closed sales than we have been over the last 5 years. We're seeing just less transactions happening. We're seeing less sellers that are willing to sell in this market. But for those that do choose to put their home on the market, they are still doing very, very well according to the data. Now, you might be asking yourself, how can this be? How is housing this unaffordable? How are rates at 7% and our local market is still on fire? So first and foremost, on a national scale, we are still experiencing inventory shortages due to a lack of new construction and underbuilding of new construction product between 2009 and 2014. Essentially, the housing market, the new construction market particularly, got absolutely whacked by the 2008 recession. And a lot of folks that were in the new construction trade simply left the trades, got into a different line of work. So we've been underemployed in new construction, or at least we were during those years. And while new construction is finally catching up to the 50-year average, there was just a large deficit of homes that weren't built during that time. And we're still feeling the effects of that lack of inventory. On top of that, as far as the resale market, we now have a lot of reluctant homeowners or homeowners that are reluctant to sell that have locked in 2 and 3 and 4% interest rates that are sitting on this very cheap debt. And I've talked to a number of folks that want to sell, want to move, want to downsize, downsize, want to upsize, want to, move out of the area, but they're reluctant to put their homes on the market because they're reluctant to let go of that very cheap debt, which is totally understandable. And in our particular local Central Virginia area, what we got to understand that our two main feeder markets, the markets that pour into ours, are Northern Virginia and the tri-state area, New York, New Jersey, Connecticut. What those two markets have in common is they are much more expensive than our market. So folks moving down from those areas see us as very cheap, and that is continuing to drive our prices up. So what does this all mean for you? I'm going to give you 3 tips whether you're buying or selling. For my sellers, number 1, realize that it is still a great time to sell. And yes, I know every real estate agent will say that. I know it sounds cliche, but based on the numbers, based on the metrics, it still makes a whole lot of sense to sell, to put your home on the market. It's still a great time to capitalize on the economic forces at play. Secondly, consider an as-is sale. So we've had a number of as-is sales so far this year, folks that have had properties that were either inherited, they were rental properties, just in need of repair, no matter what the situation was. And these are homes that maybe historically folks would consider selling them direct to an investor because they feel like they couldn't go on the market and get a great price. And what we're finding is we're able to put these homes on the market, we're able to sell them to both investors and owner occupants, and these folks are getting way more on the market even after you factor in real estate commissions than they would if they just sold it direct to an investor. So realize that is an option for you. And then last but not least, I would ask you the question of whether or not it's a great time to start your real estate portfolio or your rental portfolio. So we've had a number of conversations with folks that want to move, they want to buy another home, but they're reluctant to let go of their current interest rate, which is understandable. So a question and a discussion that we've been having with a lot of folks of, hey, does it make sense to hold on to that property, to turn it into a cash flowing rental since you've locked in this incredible cheap debt, and then just go buy your next property, but keep your current property and start building that rental portfolio? Realize that's an option. And if you want to know more about that, we can certainly chat you through it. For my home buyers, I would encourage you to realize that homeownership is still a great idea. Yes, we are at 30-year affordability lows. Yes, it's very difficult to buy a home right now. Yes, we're experiencing low inventory, and for the inventory that's on the market, it's very competitive. But in my humble opinion, it still makes a whole lot of sense to buy a home. It's still a great way to build wealth. It's still a great way to build roots in a community. And we still are very much believers in home ownership. And I think if you're going to buy your home, you've got to remind yourself of the reasons why you wanted to get into home ownership in the first place. Secondly, I would remind you that there's no signs of price depreciation right now. So we are having a number of conversations with buyers that say, hey, I'm just going to sit this out. I'm going to wait till the market crashes, because a lot of people just have that not too distant memory of the 2008 recession. You might be smarter than I am. You might have more data at your fingertips than all these major forecasters, but all the news, all the information I'm seeing, no one is predicting any major drops-offs in price. So if you're waiting to get in the housing market for prices to come down, I think you might be waiting a little bit longer. And last but not least, I want to leave you with a great website to help you, downpaymentresource.com. Once again, downpaymentresource.com. That is a great resource that you can go to and learn about all of the down payment options and grants available in our area. They actually have that available to all 50 states, but downpaymentresource.com is a great place to start to find out what grant programs and down payment resources are available to you as a buyer. So guys, that was it. That was your May 2024 housing market update. If you have any questions, concerns, thoughts, fears, throw them in the comments, shoot me a DM. Thanks for tuning in. Look forward to seeing you next month.